Have you ever wondered what it's like to earn money while you sleep? Welcome to the world of dividend investing. Now let's dive into the basics. Dividend investing is a strategy that allows you to earn a steady stream of income in addition to any potential capital gains. Picture it like this: you're planting a tree, the investment, and over time, it grows and begins to bear fruit, the dividends. These dividends are a portion of a company's earnings that are distributed to shareholders, and they're one of the ways you can earn from your investments. So how does it work? Well, companies that have reached a certain level of stability and profitability often decide to reward their shareholders by paying out dividends. These payments are typically made on a regular basis, which could be quarterly, semi-annually, or annually. Now let's talk about the amount. The dividend amount is set per share, meaning if you own 100 shares of a company that announces a dividend of $1 per share, you'll receive $100. It's like having a little cash machine that churns out money periodically. But it's not just about the amount. The consistency and growth of dividends are also important. Companies that consistently pay dividends and have a history of increasing them are often viewed as being more financially stable. These are the kind of companies dividend investors like to stick with. And remember, dividends are not a bonus or a cherry on top. They are a significant part of your total return as an investor. Over time, these regular payouts can add up and make a real difference to your investment portfolio. So, dividends sound like a sweet deal, right? But how do we know if a dividend is good or not? Stick around as we delve deeper into what constitutes a good dividend, the considerations when investing in dividends, and ultimately, if dividend investing is worth it. So, what makes a dividend good? It's not just about the size of the payout. It's akin to choosing a dessert at a lavish banquet. The biggest piece of cake might look tempting, but what if it's dry or lacks flavor? Similarly, a high dividend yield might seem attractive, but there's more to the story. The first factor to consider is the payout ratio. It's the percentage of a company's earnings paid out as dividends. A low payout ratio can suggest the dividend is well covered by earnings and thus sustainable. However, if this ratio is too high, it might indicate that the company is not reinvesting enough back into its business for future growth. In this case, the high dividend could be a mirage, set to disappear when the company runs into trouble. Next, consider the consistency and growth of the dividend. Companies that consistently pay and gradually increase their dividends demonstrate financial strength and a commitment to returning profits to shareholders. It's like a friend who always shows up when they say they will. It builds trust and confidence. Lastly, the company's future prospects are crucial. A good dividend today means little if the company's business model is threatened or if it operates in a dying industry. It's like a shiny new car with a faulty engine. It might look great now, but it's not going to get you very far. Now let's talk about the dividend yield. It's the annual dividend payment divided by the stock's price. While a high yield can be enticing, it can also be a sign of a struggling company with a falling stock price. It's like a clearance sale. Sure, you're getting a great deal, but you're also buying something that nobody else wanted. Therefore, a good dividend is more than just a high yield. It's also about the company's ability to sustain and grow that payout over time. Just like the best dessert at the banquet might not be the biggest piece of cake, but the one that's rich in flavor, perfectly moist, and leaves you wanting more. Dividend investing may seem like a no-brainer, but it's not a strategy for everyone. Now let's delve into some of the considerations when embarking on the path of dividend investing. The first thing to keep in mind is that this is not a get-rich-quick scheme. Dividend investing is a long-term strategy that requires patience and discipline. You're not going to see substantial returns overnight. Instead, you're nurturing an investment that will gradually grow and provide a steady stream of income over time. Secondly, diversification is key. As with any investment strategy, it's not wise to put all your eggs in one basket. Investing solely in high-dividend stocks can lead to an unbalanced portfolio and increase your risk. It's important to spread your investment across various sectors and companies. This way, if one stock doesn't perform well, you have others to fall back on. Another crucial consideration is the relevance of the stock price. It's easy to be dazzled by a high dividend yield and overlook the stock price. But remember, a high dividend yield doesn't necessarily equate to a good investment. The stock price matters because it reflects the company's value and potential for growth. If the stock price is falling while the dividend yield is high, it could be a sign of trouble. Also, keep in mind that companies are not obligated to pay dividends. They can reduce or eliminate them at any time. So it's essential to look at the company's dividend history and its ability to sustain these payments. Companies with a consistent dividend payment history are often more stable and reliable. Lastly, it's important to remember that dividend investing requires a certain level of financial literacy. You need to understand how dividends work, how to read financial statements, and how to assess a company's health. It's not for the faint of heart, the light of accounts, or the impatient. So, while dividend investing can provide a steady stream of income, it's not for the faint of heart, the light of accounts, or the impatient. Now that we've covered the basics, the question remains, is dividend investing worth it? Dividend investing is, essentially, a long-term game. It's not about quick wins or overnight riches, but the slow and steady accumulation of wealth over time. For those with the patience to wait, the rewards can be substantial. One of the primary benefits of dividend investing is the potential for a steady income stream. As companies distribute a portion of their earnings to shareholders, these dividends can provide a regular inflow of cash. This can be particularly appealing to investors seeking passive income or those nearing retirement who may appreciate the predictable income. Secondly, there's the potential for capital gains. If the company you've invested in performs well, the value of your shares could increase over time. This means you could sell your shares for more than you bought them, making a profit in the process. It's like having your cake and eating it too. You receive dividends and also benefit from the stock's appreciation. However, it's not all sunshine and rainbows. Dividend investing also comes with its fair share of risks. For one, it requires a diversified portfolio. Putting all your eggs in one basket or one high-dividend company can be risky. If that company falls on hard times, your investment could take a significant hit. Additionally, dividends are not guaranteed. Companies can choose to reduce or even eliminate their dividends if they face financial difficulties. Therefore, it's crucial to consider the company's financial health and dividend history before making an investment. Moreover, dividend investing requires patience. It's not a strategy for those seeking quick, short-term gains. Instead, it's a strategy for those who are willing to invest for the long haul, who can weather the ups and downs of the market, and who have the patience to wait for their investments to bear fruit. Ultimately, whether dividend investing is worth it depends on your financial goals, risk tolerance, and investment horizon. If you're looking for a potential source of passive income and have the patience to see it through, then yes, dividend investing could be a worthwhile strategy for you. So there you have it, the world of dividend investing explained. We've traversed the landscape of this unique investment strategy, delving into the nitty-gritty details to help you get a grip on the concept. We started our journey with the basics of dividends, exploring what they are and how they are paid out. As we learned, dividends are essentially a portion of a company's earnings, distributed to shareholders as a token of appreciation for their investment. These payouts are often set per share, which means the more shares you own, the larger your dividend payout is likely to be. From there, we ventured into the realm of what constitutes a good dividend. It's not just about the amount, but also the company's ability to sustain these payouts over time. A high dividend yield might seem attractive, but it's the consistency and growth of these dividends that truly matter in the long run. Next, we navigated the considerations when investing in dividends. It's crucial to remember that this isn't a strategy to produce investment income fast. It's not for the faint of heart, the light of accounts, or the impatient. Patience is indeed a virtue here, as the rewards of dividend investing are often reaped over a longer time horizon. And while dividends are a key factor, the stock price remains relevant. After all, a good dividend yield on a falling stock is a hollow victory. And finally, we arrived at the big question: is dividend investing worth it? The answer, as with many things in finance, is it depends. It depends on your financial goals, your risk tolerance, and your investment horizon. Dividend investing can provide a steady income stream and potential for capital appreciation, but it comes with its own set of risks and considerations. Remember, investing is not a one-size-fits-all endeavor. What works for one person may not work for another, but with knowledge and understanding, you can make informed decisions that align with your financial goals. Until next time, stay savvy and